Good afternoon and welcome to the latest session in the PIMFA Virtual Fest. I'm Tim Fassam, I'm the Director of Government Relations and Policy here at PIMFA, and I'm delighted you have joined us for this session on integrating ESG and climate in wealth model portfolios. I'm delighted to be joined by Jean-Maurice Ladure, who is Executive Director and Head of Applied Research at MSCI. Jean-Maurice is responsible for research to support new and existing indexes and risk models, including factors, ESG, climate change, thematic and economic exposure indices, as well as performance and risk attribution. And he serves as an ambassador to asset owners, asset managers, wealth managers, on the role of indices and factor models in asset allocation and portfolio construction. Prior to MSCI, he worked at Coutts, and we're delighted that he's joining us today for what I'm sure will be a fascinating insight into the most cutting edge views on how to integrate ESG and climate into your clients' portfolios. As I'm sure you're used to by now, please do submit any questions via the Q&A function on the website, and after the presentation has finished, we should have time to go into those questions. So without further ado, Jean-Maurice, over to you.
Thanks a lot, Tim, for the introduction, and good afternoon all. As Tim was mentioning, I'm leading the applied research team at MSCI, and I'm spending actually a lot of my time talking about our index solution with clients. So it can be market cap, it can be factor, it can be sector. But at the moment, there isn't a single meeting we're having where ESG and or climate is not on the agenda, and usually it's at the top of the agenda. So maybe I'll spend a few minutes about setting the scene, what we're seeing at the moment, what we kind of foresee coming in the future in terms of integrating ESG and climate. And then I'll go into some of the work we've done on how really to integrate ESG in model portfolio for wealth manager. And by integrating ESG, I'm not talking about putting a bit of ESG in the satellite part of a portfolio, just a bit of ESG sprinkle. I'm really talking about potentially putting ESG first in this approach. If my screen moves, perfect, sorry about this. So what are the trends we are seeing at the moment? It's very clear why it's moving now. The regulators are definitely pushing, TCFD, SFDR, and the rest are definitely having an impact. We're seeing company more and more taking notice, especially if they want to borrow or issue some more equities. ESG start to be a key element into it. And finally, and most importantly, the clients are really demanding for it. Asset owners, the big pension funds in particular are the front of this demand, but also we see more and more demand coming from wealth manager, private bank, and ultimately from their private clients, in particular the millennials. So in this context, we see the whole ESG and climate ecosystem being put in place. As I mentioned, if asset owners and wealth managers are asking for this, the asset manager will follow. We see risk management system and other analytic tools being put in place, reporting, and obviously the investment products start more and more to be delivered. In terms of flows, it's very clear whether you're looking at US quarterly flow in sustainable funds on the top, or if you're looking at the AUM in ETFs following the MSCI ESG indices, we see a big increase. And actually the latest number was given by my product team is actually over 170% year-on-year growth in the AUM following our ESG indices. So clearly a very big trend at the moment. What could happen going forward? Now, obviously, we haven't got a crystal ball, but for us, ESG is really a long-term trend, and it is to stay. We actually went through a little kind of exercise in the wealth management context of really saying, oh, what could happen in the next 5 to 10 years in wealth for ESG? And our conviction is that ESG will impact across the whole investment process, from the investment objectives all the way to reporting. 2 or 3 interesting points in terms of what we would kind of forecast, or what we would not be surprised to see, is first, in terms of ESG objective, the fact that ESG will become a third dimension to portfolio objective alongside return and risk, just after return and risk, and the regulators are also starting to push in that direction. We would not be surprised also to see wealth clients having to opt out of ESG, i.e. ESG will be the default option, and they will really have to opt out if they don't want this anymore. And the third point is really around reporting and having this transparency, what do I own, and also around the storytelling that will be critical around the ESG offering. In this next kind of 20 minutes, I'll focus on 2 main points of the investment process, really to demonstrate that you can nowadays create an ESG-first model portfolio by going through the strategic approach and through defining really a portfolio construction approach. So we really put ourselves in a wealth manager client. As you mentioned, actually, before I joined MSCI, I was head of investment strategy for Coates, and also worked at Barclays Wealth before. So I was on the other side of the table. And I really put myself in your shoes, the shoes of a portfolio manager or a CIO, and say, okay, what can I do in terms of integrating ESG and climate, but as a kind of an evolution of what is already done, and not as a full revolution. And we put forward the following framework with 3 different components. The first component, which I will call core, kind of resonating with the concept of core and satellite, is in the core part of the portfolio, you certainly want to integrate ESG and climate alongside your traditional financial objective. You still have a fiduciary duty to your client, risk return are defined, and you just want to integrate this, ideally without modifying it too much. The second component is impact. And here it's really following some of the regulation going forward, and there's some discussion at the Open Commission on this, is to have also to ask your client question about their personal ESG preferences. Do they want to have a specific preference on social, like diversity, for example, or on environment, and to be able really to account for this and deliver a solution that really answer to those requirements. The final component is around tactical asset allocation. We do realize that it's still a very big element that needs to be delivered to a wealth client. The portfolio manager or the CIO still want to make some calls in terms of sectors or factors or currency duration. We will demonstrate that you can actually do this now with investment solution who integrate ESG and or climate consideration. So in terms of framework, we kind of started with a very standard market cap benchmark, 60-40, 60% in MSCI ACWI, which will be basically equity and developed market, and then 40% here in the Bloomberg Global Ag. And then the first step is really to see how you can really integrate ESG in the core of your portfolio and kind of create potentially an ESG benchmark or an ESG strategic asset allocation, and what are the implications for this. And then the second step, which I'm already alluding to, is really in terms of creating an ESG-first model portfolio, where here you really try to populate your core bucket, your impact, and your tactical with ESG and climate solution. Then obviously you look into equity and bonds. You want to still to control your asset allocation, but certainly your ESG approach is the first thing you want to look at. The 60-20-20 is just a simple illustration. Be aware that hopefully very soon we will be able to release a little app where a client will be able to play with those weights and see how it behaves. In the next few slides, you will see that I will only focus about MSCI indices, just because first it's simpler for us. We've got full transparency of the constituent. And also, as you've already seen, there's actually a lot of passive investment solution ETFs which are following those indices, and also a lot of active ESG managers who are using those indices as benchmarks. So we didn't want suddenly to pick up some active manager and be arbitrary in our selection, so we stayed with indices. In terms of indices, very quickly to give you a feel, we've got a chance at MSCI to benefit from a lot of ESG data and research. We've got one or maybe the largest research department in terms of ESG research, analysts only focusing on the financial maturity of ESG and climate. We're talking about over 200 analysts. So they come up with plenty of information, including an ESG score between 0 and 10, and an ESG rating between CCC for the worst company and AAA for the leaders. And I'm talking about company, but then we've got this information at both the equity and the fixed income level, which is critical because you will see also here that those model portfolio integrating ESG and climate, you can now do it not only for equity, but also in fixed income. The ecosystem is mature enough to do this. So just few high-level explanation of the main indices we will be using. So you start with your pound index market cap. You can first start just to do some exclusion, controversial weapon, alcohol, maybe tobacco or thermal coal can be other exclusion, and you end up with indices you could call ESG squint. And then really you want to integrate ESG weighting, and you can do it 3 different ways. The first one is a tilted approach, whereby you still have an exclusion of the worst offenders in terms of ESG, but for the rest you will be invested everywhere, but you will be significantly overweight for the good ESG stocks or the stocks with a good ESG momentum, and then you will be underweight for the one which are the laggards. And the idea is still to be engaging with all the company, but sending this message of if you're not doing a good job, you will be underweight compared to your market cap, or if you're doing a good job, you will be overweighting. So you're really engaging. The other second approach is what we would call best in class. So here you still have some exclusion, but once you've done those initial exclusion, the main point is to get best in class. So per sector, you will, for example, take the top 50% per sector in terms of ESG. That's what we will call ESG leaders. If you go for the top 25%, it is what we call the SRI. And the final approach is an optimized one, whereby here you try to improve up to a certain level your ESG score, or reduce significantly your carbon footprint, and then you minimize your tracking error. So you still want to stay as close as possible to your initial indices. So those are optimized indices, for example, ESG focus. So having this put in place, the first step, conscious of time, is really to integrate it and really use the core holding. So here we just simply replaced market cap indices by the ESG leader, which is a best-in-class top 50%. What you can see very quickly in terms of behavior is you can improve significantly your ESG criteria. In terms of score, you move from 6.1 to 6.9. In terms of rating, you move from single A to double A. So it's already a big improvement, and you can also, as you can see, reduce carbon intensity. I'm sure you also want to see the performance. And the graph at the bottom is basically the performance of those two benchmarks. And you can see the line is exactly the same. or very, very similar. So I think the first key message from this work is you can actually integrate significantly ESG without having to sacrifice performance or to modify your risk-return trade-off. I think it's critical. And if you go into the details and look at the total return and total vol, you can see that at least since 2013, such a strategy will have added for you another 20 bips of performance per annum, and will have reduced risk by 30 basis points. And this is consistent with a lot of the research we've done, whereby good ESG stocks tend to be more profitable and have less risk, both in terms of stock-specific risk and systematic risk. Final point, tracking error is only 0.7%. So it's very, very close, but you already have a big improvement in terms of ESG. The second bucket I mentioned is impact. So it's really starting to talk about your clients on an individual basis and asking, okay, what is really important for you? And we decided to use as an illustration the UN Sustainable Development Goals, 17 of those, which are asking a good framework to use. So maybe the client will tell you, I want to make a positive impact on environment. And what we have in the background is for almost 10,000 stocks, all the developed and emerging market, large, mid, and small cap, we've got some signals and scores in terms of alignment with those 17 SDGs. Once you've got this, very easily you can analyze a portfolio, a fund, an index, and see, okay, which SDG am I particularly aligned with this specific investment solution? Or you can do the other way around. Maybe your client told you, okay, I'm really into climate. SDG 13 is around climate action. And then you can see, you can have a list of ranked of what are the investment solutions with the highest alignment to this specific development goal. Here, it would be the Global Alternative Energy Index, for example. The third bucket is tactical. That's what I used to do day long at Coates is, okay, in terms of fixed income, maybe I want to put a credit rating bet in, currency, duration, or in equity, geographies, sectors, or factors. And as you can see, now you have indices which are available to you, which will integrate ESG. Across those dimensions, the only exception at the moment is sector, but we are working on it, actually working on it with ETF providers. So we should very quickly see some products being delivered also on that dimension. So once you've got all those things in place, it's actually quite straightforward now to consider a model portfolio where maybe you want to have a best-in-class ESG integration, you want to reduce your carbon exposure, and the client may have been very specific around environmental and pollution, for example, and gender diversity. And here, you just then can populate the different buckets, both in fixed income and in equity. Again, don't pay too much attention to the weight itself. We try to make it quite simple, rounded, straightforward. There was no optimization in place here, but it's already give you a feel of what's available. And actually for each of those three buckets, we've got also, if you need, quite a long list of other indices, different regions, different countries, different themes, etc., available. And then once you've got this, very simply, you can start to analyze this. And again, on this model portfolio, we were able to analyze it since the end of 2016. You can see the ESG rating again is improved from single A to double A with a 15% improvement in terms of ESG score. You can see also quite a significant reduction in carbon intensity, 30% reduction, and a good improvement in terms of the green to brown ratio. Now, in terms of performance, it's actually even nicer than what we did in terms of core integration. And I should say, we haven't created this portfolio just to outperform. I mean, it was not part of what we were trying. We were actually trying to get to this plus 15% ESG and minus 30% carbon intensity. As it happened, and I do realize that past performance is not necessarily a guarantee of future performance, this portfolio will have outperformed quite nicely the benchmark, the market cap benchmark. 7.8% annualized compared to 6.1%, and this with just a tracking of 1%. So an active return of 1.4 versus a tracking of 1. So quite a nice information ratios there. And we've seen also during 2020 that this portfolio was also quite resilient, in line with what you would expect from portfolio integrating ESG and climate. Finally, I just want to show a few slides in terms of reporting, and I think it's critical, especially in the context of wealth clients. I was showing you just very high-level numbers. You can see here we can go a lot more details in terms of the statistics we can comment on for a portfolio against a benchmark. So you can already kind of foresee the kind of discussion you can have also with your clients. Say, oh, your portfolio, for example, has a very little tobacco involvement. You certainly have a lot more leaders company in terms of ESG. You have a certain amount of female directors. So it's make it more tangible for your discussion with clients. And obviously, we've got also the information in terms of main holdings. Here, this is on the equity part. Those are the top 3 holdings in the equity part of the portfolio. Microsoft, you will expect that you're not too surprised. It's a big company anyway. Tesla start to be interesting. It will come around at around 3%, which is very overweight compared to just its own market cap. But you will know also Tesla more and more. But even Umicore is now the 3rd one. Is one of the leaders in terms of recycling and pollution prevention. So suddenly you've got those kind of nuggets of interesting information to share with your client and make it more relatable for your clients. Visually, on slide 13, we can develop those kind of reporting, and at the moment we're getting a lot of requests from clients to create either standard or custom reporting, either for the model portfolio or directly for their client portfolio. So you can really start to have an in-depth discussion, because you've asked all those questions to your clients about what are their ESG or climate preferences. And at the end of the process, then you can come back to them and demonstrate and give good story about this. So I would like to conclude with this slide. So the 2 or 3 main messages from me is the demand is really big. There is a push from regulators. There's more and more demand from the final clients. The ecosystem is being put in place, which means that as of now, you can already create ESG-First portfolio. I'm very conscious that maybe for many of you, it's still a bit too extreme. It's very far for you. But what we wanted to demonstrate is, even if you want to go to an ESG-First, it is feasible as of now. Now it's your decision on what on the ESG journey you want to position yourself, with the knowledge that if you want to increase it further, it is already feasible. The final point I wanted to make with you, I haven't really touched too much, is it's good for the client, but I think it's also good for you as a business. ESG is a new solution, a new offering, whereby you can help your advisors having better discussion with their clients, increase client engagement, elevate the value of advice, can also help differentiating in using your insight and holistic portfolio diagnostic. And finally, and more importantly, it should help you win new business. It will be very competitive, and if we can help you in this process, we will be delighted to. Tim, I think I'm more or less on time with 5 minutes to go, so I'm very happy to conclude there and take some questions.
Fantastic. Thank you very much for that fascinating presentation, incredibly insightful. Just a reminder to people that we do have to use the Q&A facility if you have any questions on the presentation. Perhaps we get you started. I mean, a lot is happening on ESG and equities at the moment, but you briefly mentioned fixed income. Can you talk to us a little bit more about what you expect to see in this space?
Yes, so I briefly touched already in terms of first the materiality of ESG for equities. And we actually wrote some paper on this, on can ESG add alpha, the foundation of ESG and equity, and how do equity price ESG. We actually now delivered some research also on fixed income and corporate in particular. And it's interesting first to realize that ESG is different from credit rating. It is complementary, and I think it's something that is combining very nicely with a credit rating itself in terms of overall credit risk exposure. And second thing, when we've done some simulation on this, we also realized that integrating ESG in corporate fixed income portfolios or funds tend to improve the risk-return trade-off, and not only reduce the risk, but actually also, again, improve the performance. Now, in terms of trend and demand, we definitely see a lot of demand coming now also on fixed income. We've got a lot of clients who've already started the journey on equity, are familiar with our ESG research and our ESG index methodology. And now they want to replicate the same for fixed income. And we've got this capability of having an ESG rating and also climate statistics on corporate issue and issuers. And also, so with the same raw data in terms of research. And then we have also the same approach. So for example, the ESG leader, best in class top 50%, we are able to replicate what we've done on equity on fixed income. And we've started to launch indices, quite a lot of indices last year, and we're increasing our offering this year.
Fantastic. Thank you. Thank you very much. I mean, another reminder, do submit any live Q&A questions, but I wonder if you have any thoughts on, so obviously the focus of my team at PIMFA in this space is to look at the regulation, the changes to regulation that we see coming down the line, and the government has made clear that they see ESG and particularly green finance as a key opportunity for the UK. I wondered if you had any thoughts about the likely trends, be they regulatory or otherwise, that the listeners can expect to see in the ESG space over the next year or two that may have an effect on in terms of how they may want to structure their portfolios.
Yeah, so I think there's two elements to it. I mean, clearly the regulators are very active, and I'm sure a lot of people on the phone are kind of directly impacted by the requirement or the suggestion from TCFD and SFDR perspective, and we're helping as much as we can on this. So this is definitely happening. As I already alluded to, there is this regulation being discussed also in Europe around making ESG the third dimension of the investment objectives. Now, my other two comments is clearly the regulators are trying to move the needle on that. What we see, and maybe even more significantly on climate and things around green, is I think we see really a reallocation of capital from brown to green. So even if people may be maybe a bit skeptic, don't really like to be pushed by regulators, I will really highlight to them, pay attention to what's happening anyway, because others are doing and leaving a footprint. And we see it on our climate change indices, whether they are, the newly CTB, climate transition benchmark, or Paris aligned benchmark. We see over the last 18 months, 2 years, an outperformance of it certainly coming from this reallocation from brown to green. And the final point is the fact that, as I already mentioned, the companies are also paying attention, and more are coming to us to understand what they need to do, to be greener, more ESG kind of compliant, because they realize that in terms of cost of capital, and we've done some analysis on this, they will be better off if they really improve also on this. So I think it's all happening in a very virtual circle.
Fantastic. Well, thank you very, very much, Jean-Maurice. That brings us to the end of this session. So thank you hugely, Jean-Maurice and MSCI, and please do get in touch with Jean-Maurice or MSCI if you are interested in learning more about the services that they offer. There is now a short break before our final session of the day on the future of the sector, a leader's perspective. So please do use these 15 minutes, as well as to get yourself another cup of coffee or a glass of water, to have a look at all our partners' content, which you can find on the Virtual Fest website. So one final thank you to Jean-Maurice, and we will see you shortly in about 15 minutes time. Fantastic. Thank you all very much.
Thanks a lot all.